Rising inflation and sky-high energy prices, a key driver behind President Biden's announcement of the largest ever release from the Strategic Petroleum Reserve, 1 million barrels per day of oil for the next 6 months. Oil finishing, though, is down, but still up 33% this year. That's its 8th positive quarter in a row. So will the commodity complex continue to grind higher? Let's bring in Ed Moore, Citi's Managing Director and Global Head of Commodity Research. Ed, great to have you with us. Great to get your thoughts, as always. It seems like this is a very short-term solution. I mean, obviously, any release from the SPR is usually a short-term solution, but it also makes it less appealing, perhaps, for oil companies to actually open a spigot, so to speak, and produce more. I mean, if you're going to just all of a sudden lower the price of oil forcefully like that, you're not giving any incentive to the markets to actually pump more.
Well, it depends on how you look at it. Actually, prices are higher than anyone expected they'd be at this time of year. And yes, there are certain companies that are, dug into. It doesn't matter if oil goes to $200. We're not going to drill more. But I think the White House has it right this time. They've talked to enough companies to know that they've incentivized them, and they talked to in the White House fact sheet about using the National Production Act of 1950, which mandates that companies produce. They didn't specifically talk about oil. They talked about metals, actually. They talked about metals that are needed for battery power, particularly for long-lasting batteries. But they mentioned it in the context of the SPR release. And in the SPR release, they also talked about how they were willing to buy back oil, and they've told companies more or less at what price they'd be willing to buy it back. So I think this has incentivized a number of companies to raise their drilling activity. We're already seeing it in the increase in drilling rates. And I think we'll be surprised to the upside. The White House is talking about, getting to 1 million barrels a day of growth by the end of the year. I think it's going to be potentially bigger than that if we look at it on a deck basis. And even on a year-on-year basis, I think we're looking at between 1.3 and 1.5 million barrels a day of incremental U.S. oil and natural gas liquid supply. That's, by the way, over and above the million barrel a day release. Yeah.
Sorry.
Go ahead.
Hey, Ed, Brian Kelly. So I'm curious on the SPR release. What we're hearing a lot is that there are diesel shortages. We saw Austin Airport warn they might run out of jet fuel the other day. So all the products are in shortage. Does this SPR release impact that? And I'm asking it because obviously that's going to have a big impact on the economy if you can't drive your truck and you can't fly your plane.
No, I think it's going to have an impact. The impact on the diesel is going to be coming from a multiplicity of factors. And we have to remember that one of them has to do not with oil, but with natural gas. So we had natural gas prices skyrocketing this year for the first time in my memory. The price of natural gas was higher on an equivalent basis than either diesel or propane. I think we're looking at parallel things that are underway that are going to reduce natural gas prices, that are going to see a switching as a result of that back to natural gas from oil. But more importantly, if you're a refiner that's upgrading heavy oil or upgrading sour crude, you need natural gas as a feedstock. And a lot of that shortage is, in addition to the high price of natural gas and switching to diesel, a lot of that is also the inability to run refineries, particularly in Europe, which is normally short diesel, and where refineries were uneconomic, even with diesel cracks at the $30 to $35 a barrel range. So I think we're going to have compensating factors for that are going to ease the diesel market as we get into the summertime.
And if we can quickly touch softs, I'm curious what your outlook is for some of the crops outlook, I mean, in terms of next year, because right now we're seeing crops that are not being planted in some parts of the world because they cannot be planted, crops that are being changed to use less fertilizer-intensive crops instead of, say corn, which may require more fertilizer. And I'm wondering what the longer-term impact is that the consumer can look forward to.
Well, the longer-term impact in crops is usually 18 months. Because that's about as long as it takes to get from one cycle to another. But we're in this unusual circumstance in which Ukraine and Russia together are close to 30% of global wheat production. Corn production is significant in Ukraine as well. It's hard to imagine how a Ukraine crop is going to be reaped, let alone sown for the next season. And we're seeing a big impact already, particularly on emerging markets. We think of food prices where we live, but we have to remember that all of that turmoil in the Middle East in 2011, the so-called Arab Spring of 2011, was due to a wheat shortage, and that wheat shortage came from Ukraine and Russia. And we're very much in the mode to have that happen. And with the economic restrictions that are imposed one way or another, Russia being a very large, the world's largest exporter of fertilizers, we're seeing problems ahead this summer. And I think we'll see that on the inflation side. We're seeing deflationary efforts underway on the energy side, but there's not much to deal with the inflation on ags. And we're worried about the political turmoil that might result, just as we saw that political turmoil in Egypt and Tunisia in 2011.
Wow. Ed, thanks so much. We appreciate it. Ed Morse of Citi. We do want to turn your attention to the 2s10s spread. It has gone negative. So right now the 10-year yield is at 2.337 and the 2-year is at 2.339. We thought we'd bring that to your attention. That's something we're watching. Obviously, this is a moment in time right now. We'll see if this sticks in terms of the inversion of the yield curve. Brian Kelly, I thought it was really interesting what Ed mentioned, Arab Spring. I mean, 2011 seems like 3 lifetimes ago. But yes, a wheat shortage caused that, and we could be in for more of that to come in the year or two ahead.
Yeah, and I don't think it's going to be isolated just to the Arab world or to Africa. They're certainly going to get hit the hardest, unfortunately. But you had mentioned there's a lot of crops here in the U.S. that they're switching. So we might have a corn shortage here. It might be something in soybeans, something we haven't thought about. Or maybe it's livestock that aren't getting the feed that they need. So there are all these unintended consequences that I think we're going to see in the fall. And you have to be worried about it. So there's a couple ways to do it. You can trade ag, or you can buy yourself one of them deep freezers and get a whole bunch of meat like BK did.
I love buying in bulk personally, Bonwin. I think that's one way of doing it. But for somebody who lives in a small New York City apartment, you're probably just going to pay higher prices. And unfortunately for the consumer, they're paying higher rents, which are sticky, right? Even though they're getting a higher wage, which is sticky also. But in terms of inflation, there are all sorts of inflationary pressures which won't be alleviated and may even get worse as time goes on, like food.
I mean, you hit the nail on the head. I mean, outside of food, I would point to rents. I mean, those are pretty much fixed costs, and without much wiggle room there, I really, again, I think it's a cautious outlook at best.